Hello everyone, welcome back. I got some really good ones for you today on this Friday, April 7th, 2023. First, I want to wish you well on this Good Friday. Happy Easter. I want to wish you well for this Passover or Ramadan. Whatever you're into, walk with your God. I think it's all good things. We have a lot of religious holidays kind of overlapping with one another. I hope we can all come together and worship peacefully. The news kind of telling me otherwise. I'm seeing some things going on in Israel. I would like to think that's kind of the human element of all this, but hey, I don't want to get too involved in that. I just want you to know there are some things going on right now in Israel between, Hamas and the Israeli security forces. That conflict's been going on forever and ever and ever. It kind of breaks my heart. I really hope that we can all worship Passover, Ramadan, Easter more peacefully going forward. That would be kind of my wish for the month, I guess you could say. But that's not what this video is for. Welcome back. Let's dive into these markets. Let's talk about bond yields. Let's talk about what risk assets are doing. Let's talk about inflation, the economy. Yeah, let's dive right into it, shall we? So, since my last video, been a couple weeks, I needed to go recharge. I would apologize for being gone, but I really did need to go recharge the batteries, spend some time with family in Sedona, the Grand Canyon. Super recommend, 10 out of 10. Sedona's a pretty mystical place. If you've ever been, maybe you're familiar with kind of the vibe you get there that kind of sticks to you, those vortices. I do recommend Sedona. Grand Canyon's cool too, but I'm partial to Sedona. What do we got going on? Well, markets have been pretty well defying gravity this last couple weeks since the last couple videos where I was discussing the Silicon Valley banking crisis, but also reiterating to you that ultimately I believed this would be bullish for inflation and risk assets because the Fed came out real quick, kind of plugged the hole with a bunch more fake money. We see on the Fed balance sheet, we've wiped out all the quantitative tightening for 2023. So we're pretty much back in an easing stance with regard to monetary policy, and that's what's keeping inflation elevated and these risk assets elevated. We've seen bond yields coming down a little bit. Last time I checked, bond yields were about 3.4%. 4% yields for the 10-year being a real danger zone for risk asset prices. So as that 10-year yield comes down from like the 4% range to the lower threes, I saw it as low as like 3.29% the other night. Well, that stokes inflation and pushes those risk asset prices higher. As those bond yields have come down, interest rates have come down as well. Mortgage rates hanging out around 6%. Talked a lot in these videos about how 7% is a bit like the danger zone for real estate. So as soon as mortgage rates, go above 7%, it starts to create an environment where a lot of potential buyers are priced out of being able to enter the market, and just borrowing costs are horrible. So as those interest rates and yields have come back down and making, real estate a little bit more affordable for people, it kind of weakens the dollar, makes more people qualified to buy, and it kind of keeps those real estate prices elevated. Now, I don't think, real estate, and especially commercial real estate, are doing particularly well this last year and a half or so, but downside for real estate price tags is going to be limited as long as these yields and rates can kind of move lower, and as long as these mortgage rates can stay below 7%. You might be thinking, well, when these mortgage rates hit 10%, then what's that going to do to housing? But I really don't think we're going to hit 10% on mortgages, because I think the Fed is pretty well done raising interest rates. So the Fed wanted to raise interest rates in order to combat inflation until they broke something, and they've finally started to break some of these more over-levered banks. So now the Fed has to take future interest rate hikes off the table, kind of buy bonds, drive yields down, drive rates down, weaken the dollar, stoke inflation. You've been seeing all of that for the last few weeks. Warren Buffett's oil buy from a few weeks ago we talked about, his $350 million oil bet, as he doubled or tripled down on his favorite petroleum company. He seems to be doing quite well. Large cap oil really bounced back this last few weeks given that banking crisis. So we'll kind of, I'm tentatively bullish on the opportunities we have in energy. So, I'm watching large cap oil stocks. I'm watching WTI crude. That's probably something you should keep an eye on. Mega cap tech doing well. Google up to about 108 a share right now. Oracle sneaking up on the $100 mark. Go ahead and add Google and Oracle to your watch list. Not a buy or sell recommendation, but I do want you to keep an eye on some of these like large cap, mega cap tech stocks. Gold, look at gold, knocking on the door for all-time highs. Okay, the high for gold, the all-time high, 2,074 an ounce. We hit that in August of 2020, and we're at about 2,020 as I'm doing this video. We talk a lot about gold in this channel. I like physical gold. I don't like the derivatives. I don't like mining stocks. I don't like GLD or SLV. I'm kind of that guy that believes if you cannot hold it in your hand, you don't own it. But as far as physical gold, silver, and platinum, looking quite bullish, quite strong. Be careful about chasing gold. We kind of talk about how it's a siren. You really got to stuff beeswax into your ears, tie yourself to the mast whenever gold is acting like this, because gold, man is so enamored with gold. She just lures you in with her song and then crashes you onto the rocks. So I love gold. I love physical gold. I think it's a part of every well-balanced portfolio, but I generally like to be buying when no one's looking, when the premiums just aren't really there. And gold has these periods where it draws a lot of interest. People get super long gold, super into it, and then we have a year where it just falls 30% and they're kind of just left in limbo. That's when I believe is the best time to sneak in and be buying precious metals, when those coin shops are empty, when no one's in them. I'm sure if you went to a coin shop this week or next week, you're going to notice some retail interest there. So just be careful about jumping in line and getting overweight physical gold at these levels. But I do like gold. I do like to see gold doing its job, and by doing its job I mean being the cost of capital, maintaining its value regardless of what its price is doing. So if we're at 2,000 and we go up to 2,100, if you sold and booked $100 in profit from that move up, it's a bit of an illusory profit in this rigged casino, because that 1 ounce of gold you sold it's just still 1 ounce of gold. So measure your metals wealth in ounces. It's a game of ounces. Stacking being a completely different game from investing and trading. Stacking is just another hat, and it's not trading, it's not investing. These metals that you're acquiring and taking delivery of, the work is already done and stored. It carries zero counterparty risk, and we kind of want to keep it that way. So good to see strength in the metals market though. Bitcoin hanging out around 28, 29,000. Wow. Bitcoin has really destroyed the long side and the short side, in my opinion, because anyone who is super bullish, well, they had to survive that dip all the way down to like 17,000. I think that washed a ton of players out. That was when we saw FTX collapse, Celsius, Luna, a bunch of players just get removed from the casino floor. So the longs kind of got liquidated, and then anyone who was waiting for cheap Bitcoin, like Bitcoin to hit 10 or 12 or 8 or God forbid 3 or 4, well, they kind of got screwed too, and now they're looking at 28, 29,000 going, I don't know. I'm hoping we dip back down. But so Bitcoin doing its job, which is as much damage to as many players as it can at once all the time. But good to see, Bitcoin holding up. Big fans of Bitcoin on this channel. Altcoins haven't really budged much. We're certainly not in an alt season. Bitcoin's been doing really well, but those alternative cryptocurrencies, they need the NASDAQ to be doing well. They need just more risk, more of an attitude of risk to be fostered in the market for those alts to really play catch up. Because at the end of the day, altcoins are not Bitcoin and gold. They're not sound money. Altcoins are speculative, unregistered security tech stocks with a lot of counterparty. They're run by a group of people. So really, altcoins to me are more like penny stock tech stocks. And so it stands to reason, they're not doing too well if they're not making a lot of money. Borrowing costs are climbing a lot. They carry a lot of they carry a lot of counterparty risk. You can kind of see why altcoins need a slightly different environment to really thrive in, which would be, to me, tech performing really well, risk in the market to be dropping, so more people want to get out there and get their cash far out onto the end of the risk curve, and a backdrop of a strong Bitcoin, strong gold, high inflation. I think that would be ultimately good for altcoins. So we're kind of waiting for the NASDAQ, the tech-heavy NASDAQ, and altcoins to kind of wake up and catch up to sound money like Bitcoin and gold. But I think we'll get there, so be patient. So we've kind of discussed metals, large cap oil, tech, Bitcoin. We like to focus on those 4 asset classes on this channel. Touched a little bit on rates, yields, real estate. I think commercial real estate is quite problematic. I'm pretty bullish on residential real estate. I do think prices are dipping, but not even back to where they were in 2020. So we're still in a very powerful uptrend with regard to residential real estate. And maybe it stays flat for the next year or two. But I'm not seeing a crash for residential real estate. And I'm not necessarily seeing a crash for commercial real estate. But commercial real estate is going to continue to struggle, all right? When I drive around these cities, I see a lot of for lease. A lot of strip centers that just, this for lease, because they just, and I think Amazon really dematerialized like most of the retail supply chain. So what I'm getting at is I think commercial real estate is problematic. I think even though a lot of these companies are trying to get their workers back into the office, there's a lot of hesitation there, and I'm not really convinced commercial real estate is going to be restored to its former glory. So maybe trades flat to slightly down, and could stay there for quite some time. So we're just gonna have to see with commercial real estate, but I do think it is a problematic area, because I don't think post-COVID our economy is gonna be returning to that pre-COVID appetite for commercial real estate. I think Zoom communications and work from home, and I really think we're gonna continue to just see that remain a trend. So I might be bullish on Amazon stock, I might be bullish on Zoom communications, but not so bullish on like commercial investment REITs or any of these companies that are trying to get 100% of their workforce like back into the office. I just don't see it. I think that some of these trend changes that we observed in the 2020 pandemic are going to become and remain entrenched, kind of like inflation. The Fed's supposed to be fighting inflation right now, but they really canceled those plans a few weeks ago with the Silicon Valley banking fallout. Now we see the Fed just trying to keep these banks liquefied and solvent, while larger banks, the big 4, JP Morgan, Wells Fargo, Bank of America, Citi, just nab up the smaller distressed capital. So you're seeing a consolidation in the banking sector at a time that you're seeing the Fed just keep the system propped up. So I invite you to look up the Fed balance sheet trends right now, see, how the Fed was able to perform quantitative tightening through the first few months of this year, and then just wipe out all that quantitative tightening in a matter of weeks by expanding their balance sheet. Ultimately, I see the Fed balance sheet continuing its march higher, okay? So a $15 trillion Fed balance sheet wouldn't surprise me. These are just toxic assets that the Fed is taking off of their commercial counterparts' balance sheets so that the commercial banks can receive, cash in exchange and keep their system liquefied and, keeping the system moving. Essentially, QE is when the Fed buys a bunch of bonds to drive bond yields down and interest rates down. And while they buy those bonds to drive yields down, they're also looking to remove toxic assets from any commercial bank balance sheet. Like, we'll use Wells Fargo just as an example, but Wells Fargo might be calling up the Fed like, look, we're kind of jammed up here. We need you guys to remove these toxic assets from our balance sheet, hold them on your balance sheet, indifferent of what happens going forward, and then give us a bunch of cash. And where does the Fed get the cash they handed to Wells Fargo to take in exchange for these toxic assets? Thin air. So the Fed prints money out of thin air, gives it to all these commercial banks, and then all these commercial banks give the Fed their toxic assets. The Fed balance sheet gets larger. The Fed becomes more powerful as their balance sheet gets larger. You know, that whole idea that, oh my gosh, the Fed balance sheet's about to hit 20 trillion. The Fed's bankrupting themselves. No, the Fed is compounding their power and their influence as they keep a vice grip on the current banking regime and keep all the people that have been in power to remain in power. You know, your totalitarian, unelected, rotational uniparty like Janet Yellen, Jerome Powell, Jamie Dimon, you know, the they that we talk about. So pretty crazy stuff. The Fed is trying to fight inflation by raising interest rates with one hand and then keep the banking sector on life support by easing, performing QE5 with the other hand. So net, I would say liquidity is no longer being drawn out of the banking system. It's getting shoved into it. And ultimately, that's bullish for asset prices and bearish for the dollar. People working for dollars, like, that's becoming a pretty raw exchange. I mean, look at how much people are getting squeezed. Just your average American lately. It's crazy. Like, average car prices are, like, I think $715 a month. I mean, that's out of control. And then a lot of these people too that maybe bought a $350,000 home a few years ago and locked in a 3% mortgage rate. Well, they're kind of handcuffed now, because even if they want to downsize with these new interest rates and these borrowing costs being so much higher, they might lose money even trying to get into a smaller home. So people are kind of like getting locked into their homes. You know, you got a really good deal a few years ago, a really low rate, you locked it in. Now you're kind of stuck. You got the average car price in America hitting about, flirting with 50,000, average car payments hanging around 715, So inflation remains out of control. I don't really see that changing. Wages need to go up, okay? If the people upstairs are going to be keeping their game solvent and liquefied and creating a ton of inflation because they're in a recession they don't want to admit they're in, well, we can do that, even though it's pretty dishonest, but we need to make sure that the wage earners in the working class, takes that ride along and gets their wage to reflect the rising cost of capital through pay raises. But this whole, I'll give you a 3%, pay raise over the last couple years and then destroy the currency by 40% so that my stock market remains inflated. Yeah, that's dirty. And so I think people who work for dollars, save in dollars, or people on fixed income, they're just getting decimated. But that's the environment that we're in right now. And if you're trying to, escape that, working exponentially harder for a currency falling exponentially faster, if you're trying to escape that road to serfdom that Michael Saylor calls it, well, you're going to want to own things, in my opinion, just my opinion, you're going to want to own Bitcoin. You're going to want to own Ethereum. You want to own physical gold, physical silver, physical platinum, maybe own some real estate, own some tech stocks, own some large cap energy stocks. That to me is kind of the weak dollar plays, all right? So as the dollar weakens and the inflation remains a problem and entrenched, I expect, those asset classes I just mentioned to at least do their job, which is keep their value in the face of a falling currency, globally. So all fiat currencies, it's not just the dollar I'm picking on, all government issued fiat currencies priced in gold are near all-time lows, meaning the gold price in most fiat currencies on earth right now is near all-time highs. And gold being at an all-time high, I'm going to leave you off on this and then let you go. Gold at an all-time high is just the dollar at an all-time low in real terms. You know, you can bring up a dollar chart, DXY, UUP. There's a lot of different derivatives for the dollar, which essentially isn't just the dollar. It's usually a basket of like euros and dollars, but we'll kind of leave that alone. If you look at the DXY chart right now, you know, that's going to tell you one thing, but that's just the dollar relative to other currencies. So you're not going to get a lot of information when you look at the dollar chart, because you're just looking at dollar strength relative to other fiat currencies. If you want to know the dollar price and strength in real terms, measured in real terms, you take a 100-year gold chart and you invert it. So with gold near all-time highs right now, invert that chart. That's the dollar near all-time lows. An inverted 100-year gold chart is a dollar chart in real terms. Not nominal, but real terms. So that's really all I got for you for right now. Hope this video finds you doing well. Like, subscribe, share, comment, whatever. You guys are awesome. And we're just going to keep going, all right? Thanks for watching. Till next time.